I'm Bethany LaFlam, and I've been an attorney for 23 years, representing clients on countless business transactions in the startup, technology, aerospace, medical, and now the real estate industries. I have analyzed and advised on hundreds of real estate investments, providing SEC compliance and deal structure. So I help you practice safe SEC. My unique superpower is facilitating both passive and active investors in creating conscious wealth through education, access to opportunities, and strategic mindset shifts. In addition to providing legal compliance, I advise on business strategy and scaling using OPE, other people's everything. One of the ways we can do this is other people's deals. Did you know that most multimillionaires became that way by investing in real estate? One of my favorite ways to create conscious wealth is through real estate syndication. Not sure what real estate syndication even is? That's okay. Your rich best friends got you. Real estate syndication is when two types of real estate investors partner together to acquire real estate. It could be apartments, single family homes, mobile home parks, self-storage, even boutique hotels, any kind of real estate. Those two types of investors are active investors and passive investors. Active investors are the ones who do all the work of finding the property, researching it, doing diligence, underwriting, improving the property, increasing its value, and overall running the property. Active investing is a great way to break into real estate if you don't have a lot of money of your own to start, but you do have the drive to work hard. That's right. You can become a real estate investor even if you don't already have a lot of money. But what about you? You're a high income earner. Maybe you have some money. Passive investing might be your lane. Passive investing is when you have some money you want to put to work to make more money for you while you sleep. But maybe you don't have the time or the inclination to do all the work it takes to be an active real estate investor. If this is you, you can find active investors that you trust and invest your money and still reap the rewards of real estate ownership. Once you decide which lane is your lane, just be sure to leverage all of your OPs, your other people, to cover the rest to be sure that you're building your empire safely. One of the biggest roadblocks to passive investing that I see is really just a mindset shift away from being a valuable tool. Let me explain. You're here because you're getting that education component that I mentioned as one of the three elements to creating conscious wealth. The access to opportunities will flow once you know what you're looking for. So it's really just a simple mindset shift. Let me help you recognize what to look for when you're seeking a passive investment. The first thing is the importance, and I cannot emphasize this enough, the importance of due diligence. Your sponsor team or the GP team, the active investors that you're looking at, they should have done their diligence and you're expecting them to have done their diligence on the property. You need to do your diligence on them. A quick Google search can give you some information that you need to know. I mean, a lot of us ladies, we know how to do the internet stalking. Put that skill to work and do a Google search, do a deep dive into the social media, whatever it is that you have access to, into the backgrounds of the sponsor team. There should be a bio in a pitch deck that you get, the pretty pictures that you get in a PowerPoint presentation. There's going to be a bio in there of all the people that are shot callers in that deal. Who's making the decisions in this deal? You've got to get yourself comfortable with that. Do the Google search. If there's anything in there that gives you pause, maybe dig a little bit deeper. If it gives you so much pause that you feel like you need to go hire a private investigator to dig deeper, trust your instinct. That might not be the deal for you. But other than that, ask questions. The sponsors, they want to communicate with their investors. They want investors to ask questions. They want them to get comfortable. Responsible sponsors do, right? I always tell my clients who are mostly real estate active investors, I always tell them you don't want what we call dumb money, which is a really harsh way to put it. But what that means is people who just say, you know what? I trust you. Just take my money and make me some money. I tell my clients run when someone says that, right? You don't want that because then things go south. As a passive investor, you're feeling scared because you don't understand what it is you've gotten into. They want you to ask questions. And it's okay to dig until you're comfortable. If you want to know, hey, what is it that I see in your background? You've got a bankruptcy or I see there might be some litigation, whatever it is, you can ask. They should be disclosing that to you anyway. In fact, they're legally obligated to disclose anything that might be material to your ability to make the decision of whether or not you want to invest. That's why selling securities is different than selling literally anything else. The SEC, the Securities and Exchange Commission, exists solely to protect you as a passive investor from people scamming you, right? And so what they have to do is they have to provide all of the information that you might need to make an informed decision of whether or not you should invest. So do your diligence. Sometimes that diligence is just making sure that you're comfortable that they've done diligence. It doesn't mean you have to go to all the properties that you might be looking to invest in. I mean, that's the point of being passive, right? But there's no truly passive investing until after you've done this initial diligence, right? So make sure you do the diligence. That's really important. Vet your active investors well, or the sponsors of the GP team. The next thing is, what is the anatomy of an offering document? Like, what is it that you're going to be asked to sign? And this is, people kind of get hung up. I've had people come to me that are passive, just like, can you read this 100 and something pages of documents for me? Because I just cannot, right? Totally understand. You don't want to spend all your time reading all, 100 and something pages of documents. But here's what I'm going to tell you. You should read it. You should. Now, I understand that you're probably not going to read every single page. So what I'm going to do is I'm going to break down where you need to really be paying close attention and where you can kind of just skim over like, okay, that's the law part, right? I mean, the first thing you want to look at is, does your investment team or your active investment team, do they even have offering documents? If they don't, run, right? Or at least ask why, and then get yourself comfortable with why. If they think they don't need them, why not? Most sponsors, if they are going to come to you with a passive investment deal, they're gonna have a PPM, especially if they don't already know you. So a PPM is a private placement memorandum. That's what that means. What that is, it's a big scary document that has a whole bunch of disclosures in it that lets you know what is the anatomy of this particular deal. What's the asset class that it's in? Tell me a little bit about the sponsor team. What am I getting as an investor? What fees are the active investors getting out of this deal? It should break down all of the extra risks or any specific risks of this particular project that they're doing. You should, by looking at the PPM, you should know exactly what this deal has to offer and what are the scary things that you might want to consider in whether or not you want to invest. That's the PPM. Along with the offering documents with the PPM, you're also going to see what's called either an operating agreement, or sometimes it's called a limited partnership agreement. Basically, all that is, it's the agreement with how you enter into the company. You're going to get membership units or partnership units. That's how you own your little piece of the company. That's the security, right, that you're getting. So you're going to take a look at that, and you're going to want to make sure that that actually matches what the PPM says it's going to do, which is why you actually have to read them all, or at least have your advisors read them along with you or for you. Beyond that, you're going to see what's called the investment questionnaire or investor suitability questionnaire, something along those lines. And what that is, it's a document that's going to ask you actually a lot of kind of personal questions. It's going to ask you what your net worth is or what your income is. It's the document that really helps the sponsor team get comfortable that you are a suitable investor for their deal. I always advise my clients to make sure they get that information from their potential investors before they accept the investment, just to make sure that it's a good fit and to make sure that they can responsibly accept your money. Now, you're probably an accredited investor, so that's one extra step that the sponsor team needs to do if they're offering it only to accredited investors, which is to verify that you are accredited. It depends on what kind of offering they have. You've probably heard of 506B and 506C, and those are two different kinds of offerings. So the level of diligence that the sponsor has to do on you depends on what kind of offering they're giving you. But that part's on them. Then you're going to see a subscription agreement. The subscription agreement is really the document that lets the sponsor team know that you're actually going to invest. It's going to say how much you're putting in. You're going to sign it. It's one more time. It's going to say, you understand this is really risky, don't you? You understand you might lose your money, all the scary things, right? And that really does work to turn off a lot of investors. And it's meant to turn off the investors who can't live with that level of risk. But I'm here to tell you, the documents themselves shouldn't be the thing that gets in the way of you creating your conscious wealth, you getting passive income. The documents, yeah, they seem a little bit scary, but once you know what you're looking for, once you're educated enough, you can start to get comfortable with your ability to make good decisions as it relates to these kinds of investments. So what I want to do is I want to walk you through what you should be looking for if you don't actually want to read all 100 and something pages of it. Now, as the lawyer, I have to tell you, you should read it. But if you're not going to, at least make sure you look at these things. The first thing, believe it or not, that I always tell people to make sure they look at is the definitions. A lot of people just skip right over that part. They're like, oh yeah, whatever. Let me get to the meat of the definition or past the definitions. They think it's like a table of contents or something. The definitions are really important because as a lawyer, what I do is I break down and define sometimes really complicated concepts that I'm going to repeat more than once, right? Because I don't want to have 6 paragraphs of talking about this really complicated thing and then do that 6 times in a document. So if you read through the definitions, some of them are going to be the basic definitions of this is just how a real estate deal works. This is the securities law part of it. So specifically, which definitions should you even be looking at? Well, first one is look for anything that talks about fees to the manager or the sponsor team. Fees. They are required to tell you what they're charging this project in addition to whatever profit they might be getting. Right. So the fees that are typically going to show up in a PPM that you should look out for, an acquisition fee. What that means is that the sponsor team is going to take some percentage, usually of the purchase price at closing for having found the property, for doing diligence. It's a totally reasonable fee that a lot of people take, but you should check and see if it's within reason. Usually we see between like 1% and 3% of the purchase price. Sometimes it's more depending on the asset class, but you should look at it and just get comfortable with the overall fee. And you're gonna hopefully get to look at some underwriting, and you'll kind of see based on what the projected returns are if this number seems way out of whack and skewed high in the favor of the sponsor team. You want to make sure that they're not going to fee the deal to death to where you actually don't see a return. Another fee that you often see is called an asset management fee. That's usually defined in some percentage of gross income of the property. Pretty normal. We see about 1% to 2% of an asset management fee. That's pretty normal. But again, you're going to want to take a look at the pro forma, the underwriting, to see if that makes sense for this particular deal. A couple other possible fees that you could see. There's what we call a capital transaction fee. That's going to be like a refinance fee or a fee at the sale of the property. And that's usually, again, some percentage of the new loan amount or some percentage of the sale price. Again, you're going to want to make sure that just looking at that, if the numbers make sense for what the fee is relative to the loan or relative to the sale price. Another fee you might see is a loan guarantor fee. Pretty normal when the sponsor team is putting their own credit on the line or signing or personally guaranteeing a loan, that they might take a fee around 1% or so of the loan amount to compensate them for risking guaranteeing the loan. Some other fees that you might see, if you actually see, this one really bugs me actually, if you actually see like an equity fee or a capital raise fee or something like that, question your sponsor team about that. That's actually something we really frown upon. Because nobody is really supposed to be making a fee for raising capital unless they're a licensed broker dealer. So those things that are tied to the equity raise, I don't really love to see. If they're my clients at PLG, then they shouldn't have that in there unless they added it after I saw the document. So which of course they don't do. So you don't want to look for an equity, or I'm sorry, you do want to look for, but you don't want to sign up for an equity fee. But you'll look at it. You look for the word fee, look for the word compensation, but make sure you just kind of skim through the definitions to see what kind of fees there are. Another definition you're going to want to look for is a preferred return, if there is one. A preferred return just basically means that there's some percentage of a return that you're going to get on your invested capital before the sponsor team is allowed to start taking any money, right? Preferred returns can look a couple different ways. So you want to make sure you understand the order in which the fees are, the profits are going to get paid out, the first of which is usually the preferred return. So you want to start to see where you are in line to getting money. Usually the fees come off the top before any money is distributed. So you want to make sure you're comfortable with the fees and then comfortable with whatever the preferred return is. After the definitions, you're going to want to find somewhere in the document where it talks about the waterfall or the order of things getting paid out, right? And so like I mentioned, usually the first thing, if there is one, is a preferred return. Not all deals have preferred returns. Don't panic if there isn't one. It just depends on the asset class. It depends on the specific deal. But if there is a preferred return, you want to look for that. Then you want to look for the order of the profits and what is the profit split if there is an equity split. 80-20 is sort of standard where people start from, but it's not always 80-20. Again, it's going to depend on the asset class. It's going to depend on the specific deal that you're looking at. Sometimes it's even 50-50, or it's even 20% to the investors and 80% to the sponsors. That might sound outrageous, but don't let that turn you off right away. You're going to want to look at the underwriting to see what are the projected returns. Maybe this thing throws off so much cash that it makes sense to do that. Maybe it's a development deal, whatever it is, you want to look and make sure that the pro forma makes sense. You're also going to want to make sure that whatever pitch deck or other marketing materials you saw leading up to you getting the PPM matches what the PPM says. Does the PPM say whatever the sponsor told you was going to be the deal when they pitched it to you? That's really important. You want to make sure that it's not sort of a bait and switch, which is why you do need to read the documents. But even if it's unintentional, you also want to look and make sure that it's still actively reflecting what the deal is currently. Maybe you saw an old business plan, maybe somebody misunderstood. This is the time to make sure that you're really clear. Again, ask questions. Your sponsor team wants to answer your questions, I promise you. And if they don't want to answer your questions, you should run. So the next thing you're going to look at is you're going to make sure what all the risks are. There's going to be two sections in there. One of them is the business plan section. That's the thing where the section in the PPM where it talks about like, what are they going to do with this property? It should match the business plan. And then what are the risks? Is there some crazy extra risk that you should know about before you get into this deal, right? Is it built on some sort of like Native American burial grounds, or is it on a city dump, or whatever it is? Those risk disclosures should find their way into the PPM. So you want to make sure you're reading the risk disclosure section. Most of the other sections are going to be stuff that's sort of, I want to say boilerplate that like these are securities laws. We have to have these things in there. Those kinds of things you can kind of skip over. Once you start to get comfortable with these sections, these documents get easier and easier to read. I would actually say for the first time, read it all the way through. Pour a bottle of wine or pot of coffee or whatever it is to get yourself through those documents, get comfortable with them. And then you're going to start to learn which parts you can kind of gloss over and which parts you really need to dig into. Also, red flags to watch out for: unusually high fees, as I mentioned, no PPM at all, as I mentioned. Any too good to be true statements are usually going to be too good to be true. No promises, no guarantees. If they start to promise you or guarantee you anything, run. And so once you know what to look out for, you're going to start to build up the confidence that you can select the best passive investments to suit your personal goals. And there's no shame in asking for help from your advisors. In fact, I highly encourage you to ask for help from your OPs, your other people. You can learn all that you can. You start to build that confidence so that you need them less and less and less. But don't let those OPs make the decision for you. You got to start to learn to trust yourself. And that's where I find that women sometimes run into trouble, is they don't trust themselves. You've got access to all the things you need. You've got access to the education. You're here. You've got access to the opportunities. This is a community for you. And then you've got access to the tools you need to shift your mindset to knowing that you can do this. So my challenge to you is to seek out 5 new opportunities to vet in the next 30 days and look for all the things I mentioned, right? So you can start to get comfortable and in this process. If you don't find a deal or a sponsor team that's a fit for you in those 30 days, then the following month, look for 10 new deals. And you keep doing that, and you will find a deal that works for you eventually. You can do this. I am here to help. If you check out my YouTube channel and Instagram for more advice, I always post some content that'll help guide you through this process. I'm always available. I do a free live every week to talk about various questions. Usually it's syndicators that are on there, so it's a great place for you to come and listen to what people are asking. But I also invite you to join me on Bubbles with Bethany each Thursday at 4 o'clock Pacific, 7 Eastern. And what I do there is I have amazing guests that come on, and what they do is they discuss what conscious wealth means to them. And every once in a while, I will have the occasional opportunity that you can watch me vet live. So you're going to hear me grill a sponsor. You're going to hear the questions that I ask the sponsor team. And so you can learn from how I'm asking them questions, and you can learn by how they're answering. Who knows, maybe you'll find an opportunity there. If you email team@plglp.com, you can get the registration link, or you can find it in my bio on Instagram at Bethany_LaFlam on Instagram. I'll see you there.